One, two, three. Hello everyone, welcome back to the channel. Guys, in this video I'm going to explain to you the power, or in other words, the magic of to keep the dream alive in terms of keep rolling or keep managing our cash secure put options, okay? I have mentioned in this channel many times, for those of you that are going to be an option seller, which it is what I do myself, I occasionally buy options, but it's very rare. Probably I have bought option maybe three times. I mean, like in terms of period. One was 2019, the trade war between the US and China. 2020 the crash, and 2022 bear markets. Apart from these, guys, I'm always selling options, and I'm gonna show to you here a trade that we were involved 125 days, roughly 3 months, okay? And the trade went against us. We were losing money, but at the end we came up ahead $187, taking consideration all the fees that we pay here, okay? You can download this Excel spreadsheet on the first link below, and just click the button and you can change however you like. This is just the management part of a massive spreadsheet that I have. We have the entry here, we have the trade management, we have the closing, and all the analysis in terms of the trade outcome, like rate of return, annualized rate of return, and so on, okay? But what I want to show you here, like I said to you guys, it is the power of selling cash secure put, buying back here when it is out of the money or maybe in the money, and so on. Because if you know how to manage your trades, you are 50% ahead of everyone. But of course, I'm talking about here all the cash secured put going to expiration date, okay? Because I will put another video in relation to how to manage the cash secure put option. This is just to roll in the put, or in other words, rolling the puts that expired in the money, okay? In the money. That's all. That's all about it, because we don't need to wait here in this case here for the put to expire, let's say, at the expiration date for us to manage this trade. We can do a lot of stuff even before the expiration date. So just bear that in mind, okay? This is the case when you say, oh, damn, my put, it is in the money. What am I going to do? And this is what you're going to learn in this video here, because if the put here get assigned, we can transfer this thing here to a covered call, okay? Or in other words, the wheel strategy, we can sell another put, or we can just transfer this thing here to a covered strangle. And I have a strategy like this in my channel, so you can go and learn yourself how to do, how to manage, and how to make money using those strategies. But in this case here, it's just a cash secure put. We are just going to roll the trades that we haven't got assigned yet, but it's still trading in the money, okay? Anyway, without further ado, let's get on to the video. So here, hypothetically speaking, on 18th of December 2023, we sold a cash secure put, sell to open STO on EWZ. All the tickers is going to be EWZ, of course, because we just rolling the trade. So in this case here, the stock was trading at 35.27. We sold a put option, the strike price of 35.33, actually, sorry, and we collect here 95 cents, okay, for this trade. And the reason why roughly this price here is because we're pretty much selling here at the money. That's why you're collecting a little bit more premium, because if you sell here, let's say 30 delta or 40 deltas or 25 deltas, you're gonna get roughly 35 cents. But because you're pretty much at the money, in other words, the strike price is almost exactly at the current price, that's why we're getting a little bit more money, okay? And for this, of course, we received here 95 cents and we paid $1.15 commissions. And commission is going to be same throughout the whole example, okay? $1.15 to open, $1.15 to close. So just bear that in mind. So don't need to repeat myself. So the trade was filled. Then, on 5th of January, the expiration date, after 18 days, okay, the stock was trading at 34.25. And of course, because the stock price, it is above our strike price 33, the option expire out of the money, we pretty much close there for 10 cents, okay? What I mean is, like, if the option in the expiration date expiration day, for example, if your options is pretty much out of the money, just close the trade. Just close the trade, because things can happen after market hours. Just close the trade. Pay 10 cents to close the trade. Pay, for example, 5 cents to close the trade. Get rid of that and move on, because things can happen after market. So we closed there and we just moved on with that trade. And then on 5th of March, at the same day, what we did is, with the stock price trading 34.25, we sold another 33 cash secure put. We collect $1.07 and we paid same commission. So the trade got filled. Thank you very much. Appreciate. Let's move on. On 26, after 21 days, the stock price dropped to 32.78, which it is below our 33 strike price. In this case here, the option expired in the money. Okay, so what we did was, because it was in the money, we had to pay 22 cents. And the reason why we have to pay 22 cents to close this put option is because, as you guys can see, we are 22 cents below our strike price. So this is the intrinsic value. Basically, we are closing this put here for 22 cents, which it is how much this option is costing right now. And at the same time, at the same day, all right, we are opening another trade to expire in 39 days with the stock price trading at 32.78, because it is in the money. We're gonna sell at the same strike price at $33. But now we are getting here. In other words, we're buying time. We buy another 39 days for us to give ourselves enough time for the stock to recover. And we are collecting here 25 cents. Why? Because the reason why we are collecting a little bit more than we are paying, because of this time value. The options with the long duration always have more time value than the options expiring in the money, because this one here has less value than the option expire future ahead. That's why here we paid 22 cents to close and we received 25 cents to open. So in this case here, we got here 39 days and we made roughly $3 for this trade. We haven't made much, but guess what? At least we bought ourselves more time. And then on 5th of March, okay, 5th of March, which was expiration here that we had after 39 days, what happened was the stock dropped even more to 31.07. And remember, we have here the strike price of 33. So we had to pay $1.93, which it is the intrinsic value here between 33 minus 31.07. So we have to pay here $1.93. But what we did was, at the same day, we also sell to open here another option which on expiring 28th of March, 23 days ahead, and for the same strike price, and we collect $1.97. The same thing here. Okay, here we have more time value. Thank you very much. So here we have more time value. That's why here we are getting more money to sell here and to sell here than we are getting to pay here and to pay here, just because we have more time value in those options. Okay, just bear that in mind. Very important that you know exactly what I'm talking about. And then on 28th of March, after 23 days, the stock recovered a little bit to $32.95. But remember, our strike price here is still at $33. So in other words, the option is still trading in the money. Okay, this is all trade taken to expiration date. So what happened was we had to pay 5 cents here, because this is exactly what the intrinsic value of this option is. And remember, only options trading and expiring in the money has intrinsic value. Okay. And what happened was, and then what we paid 0.05 cents, but on 28th, same day here that we bought to close this option here, we sell to open here another one with 24 days ahead with the stock trading at $32.95. But at this time, we dropped the stock strike price actually to $32. We went from 33 to 32. Why? Because this is possible when those options are trading, guys, very close to the strike price. Once we have your strike price and pretty much close what the market price is, you have more chance okay, to manipulate your strike price. But of course, you're gonna pay for that. That's why in this case here, we only received 5 cents. Exactly what we paid for. Why? Because despite the fact we increased the DTE here, which is 25 days ahead, we spend the money here that we received here in time value to pay for this lower strike price. But of course, we went from a trade to be in the money because it was 33 to be out of the money because the strike price now is 32. But of course, we have to pay the price in premium. That's why we didn't collect, let's say, despite the fact that the market price here was close to a strike price. If we have rolled this thing here for $33, we could have received here 25 cents, 35 cents. The difference that we paid here, it is to compensate that we drop here our strike price. Very crucial that you guys do understand this procedure here. Because and then after 24 days, on 21st of April 2024, the stock price recovered a little bit to 32.34 and expired out of the money. So this option here, guys, was pretty much worthless. Of course, in this case here, we let expire the money. But of course, we should have put here, let's say, for example, okay, the same thing that we did in this case here, that we pay 10 cents. So here, for example, what I'll do is, okay, we can put here that we paid, in this case here, let's say that we close here for 5 cents, okay? That's the best procedure so you guys can learn the right thing to do. I do not let my option expire worthless and then that's it. Why you're gonna have those risks, especially with the things that can happen after market hours, okay? So just close here for 0.05 cents and move on. That's it, done. The option expire out of the money. So basically after we have paid all this premium to close the trade, the money that we received, everything, the commission, being the trade for 125 days, with an average of 25 days, we still made $180. That's how powerful it is, guys, because look at this. We start here with the stock trading at 35.27. At one point, the stock price went down to 32.34. Which in other words, the stock dropped 8.31% and we're still making $182.50. This is the power of rolling your options. But I want you guys to pay attention to one thing here. I don't know if you guys notice one thing I haven't talked about during this video. Look at this, guys. Okay? This is one contract. Because in this level here, in this step here, where we went from 32 to 32, 33 to 32, the reason why here we spend our time and value here, the premium that we sold here to do this strike price here procedure, we could have sold here 2 contracts, getting more premium and do this work here. But we don't need because the stock price is almost at the strike price of 33. But if it drops a lot, what you can do is you can increase the risk a little bit, increasing the number of contracts and dropping your base cost. Again, with the proper position size, because if you have the wrong position size here, you start with 5 contracts, jump to 10, with the stock trading close to the strike price, it doesn't make sense. The more the market run away from us, the better it is for us to double our contract size. But this double contract size, what I mean is, I could go here to, let's say, to 5. Okay, because if I lose, let's say, 5 contracts here, and if I lose this trade, that could be 1% of my portfolio, 2% of my portfolio, 5% of my portfolio. But these 5 contracts cannot be 50% of your portfolio, 20%, 10%, guys. Anything above 5%, it doesn't make sense. All this thing here was possible because with the proper position size. Keep that in mind. Very, very crucial that you guys do understand position size when it comes to be option sellers. That's why I always talk about it. That's why I always brag about it on all the videos that I have in my channel. Watch your position size, okay? Because the main thing here, it is to be able to drop our strike price without increasing the number of contracts. But if we were to increase the number of contracts, we need to make sure that we're dropping our base cost all the way up here to all the way down here. Otherwise, no worth. Okay? Anyway, this is a simple explanation how to roll your cash secure puts that has expired in the money without any kind of, guys, trade management before the expiration date, because we can close before, close out. There's plenty of things we can do. This is just the rolling procedure, okay? And if you have any question, just leave below in the comments and I'll get back to you as soon as possible. Okay, all the best, stay safe, and happy investing.